Thank you so much, Saul, and greetings to everyone. And congratulations to us all for a fantastic session. In this session, we are going to hear some presentations from three eminent speakers. And I'm delighted to introduce the floor for them. Professor Elvis Avenel is our first speaker, and he will be touching on issues relating to green transition minerals, infrastructural transformation in Africa. After that, Mr. Lloyd will talk about some issues relating to geological endowment and industrial power. And then Dr. Bogdanov will now conclude with the last presentation on pricing risk in Africa's largest economy. Just to confirm that all my speakers are here, Elvis, if you can hear me, Mr. Lloyd and Dr. Anushka. Great. I see Anushka. Elvis, if you're ready, I think we can take your presentation now. And all the best.
No, thanks, Rex. And also thanks to Saul, Roselle, and of course the scientific committee for organizing this year's alumni conference, but also for having me. My presentation this morning is based on a report a couple of friends and myself we worked on for the office of the chief economist for the African region of the World Bank, trying to understand how the continent could leverage its critical minerals for social transformation. And to sort of try to understand some of these issues that is confronting the continent on this new in this new industrial age, we decided to sort of take an analytical but also an innovative perspective on how we can shift our production strategies necessarily from a very pit to pot extractive model anchored to a high value production of both green transition minerals, but also green technology, green transition technologies. We undertook a couple of exercises, and I would sort of run through them quickly because I only have 12 minutes. But a key point I want to make also sort of links up quite nicely with Faisal's presentation of how we've started thinking around extending Faisal's framework of developmental regionalism, particularly to green transitions. And I'll spend a bit more time with that discussion. So we do know, of course, now that the global shift to low carbon economy has increased demand for green sort of transition minerals, cobalt, lithium, and rare earth minerals, which are essentially forming the basis for the production of most of the green technologies that we currently use. In 2025, the IEA came out with a report that showed how significant transformations and demand for these green technologies is driving both investment in these technologies, but also investments in the exploration, but also in the mining of these critical minerals. And given that majority of these minerals, as we've done as part of our exercise, majority of these green minerals are linked largely to the technologies, but also majority of these minerals are found on our continent, but also produced on our continent. There are discussions. There's several discussions around how then these sort of opportunities present a new window of opportunity for the continent to leverage this new wave of transformation that's happening. We do know a couple of things that the continent exports majority of these minerals from the trade data. We do know also that most African countries export at least 4 of these minerals, with South Africa and some key countries such as Nigeria exporting about 40 of these minerals. But also we do know that the continent plays a sort of a significant role in the export shares globally when we focus largely on cobalt and products like manganese, for instance, right? And what is also emerging from the trade data is also that these minerals are largely exported to China with very limited intra-Africa trade. We do see from the trade data that there are specific minerals that are receiving some amount of trade with some countries serving as export destinations. For instance, Zimbabwe serving as the main export destination for tellurium. We do know South Africa serves as an export destination for nickel, for instance. While we do know Mozambique, for instance, serves as an export destination for celerium. Where is it now? Celerium somewhere. Yes, right. But the point is that there's room then for increasing regional trade, but also going forward, increasing the value of these minerals, because from the data that we also analyze, we do know largely that majority of the minerals that we export are unprocessed. We do see, for instance, copper being processed. We do see cobalt being processed to a large degree on the continent, as well as nickel. But we also do know from the analysis that majority of these sort of processing activities are quite rudimentary. So cobalt, we only have the sort of cobalt maps, for instance, right? So there's room also for value creation and then value value capture. So if there's room for that, do we have the capability then to be able to sort of add value? And sort of thing we've done is also trying to understand some of the processing capabilities, particularly on the continent. We do see some existence of, we generally say scattered capabilities on the continent, with South Africa and DRC largely driving majority of these capabilities. But largely, most of them are also tend to be plants, and again, adding very little value to some of the intermediate products that are exported really. What we do know is that China, majority of the processing happens in China. And we do also know now that majority of our exports go to China for value addition, right? So there is a need, particularly if you want to undertake structural transformation, there's need for us to be able to reverse such trade flows. So the evidence that is emerging currently is that we need to sort of reverse the enclave sort of characteristics that we do know sort of characterizes majority of our trade, and we've been exporting gold and other minerals for so long, and we do know some of these characteristics are quite inherent. And what that happens, or what that leads us to, is around preventing us from sort of domestic value addition, but also enabling us to generate some strong linkages with the mining sector to also some other industrial activities. We do see currently from some of the analysis that we are doing that some countries are signaling their resolve to break free from some of this sort of the extractivist trap, for instance, right? So some of the analysis we've done is simply trying to understand what sort of green value sort of capture initiatives countries are formulating. And we do see that there are a set of policies that are looking to beneficiate, but also simply add value to their minerals. We do see some of the policies trying to localize some of the production processes, some of the policies looking into some of the sustainability issues that Faisal was talking about, but also some cases where we do see a much broader sort of policies where countries are also looking to sort of nationalize some of the production processes in ways that they can either capture ownership, but also value of some of these green minerals. What we've also seen is around some sort of partnerships occurring on the continent, right? And one key example I wanted to sort of highlight here is the partnership between DRC and Zambia around EV batteries, which was signed, I believe, in 2022. But we also noted USA coming in to sort of form a sort of a trilateral relationship with with these two countries. And since then, we do know that nothing has happened of that sort of partnership. So there are issues, right? And one of the key issues that is emerging is that at the moment, how things are playing out, we stand the risk of losing out in the emerging green transition and the industrial order, and that it's sort of a simple fact. We do see clearly that, and despite we have some of the mineral reserves and we produce some of these minerals, our participation in the value chains, but also our position in the value chains are quite weak, and we do see generally some paradox of potential without power. And we do know as well that the continent remains quite confined to the upstream sort of the extraction sector of most of these value chains. We do know that majority of the processing, as I've already shown, happens in China, where majority of the value is captured. So there are fundamental structural issues, and there are also very fundamental structural configurations. In our view, that sort of undermines the continent's ability to sort of leverage the green wave, but also leverage its own minerals for some sort of broad-based industrial development that we want on the continent. So what we've been trying to do is go back and trying to build on Faisal's work on the developmental regionalizing framework, right? He's already explained this, so there's only going through these. But the point is, there is sort of a lot of work in this area, and what we try to do, particularly, is to sort of bring a new thinking around how we can sort of extend that sort of framework to green transition, but also to issues around sort of a much broader sort of transformation. So what we are doing is around integrating as a foundational driver of growth and development on the continent, our green transition minerals. And here we are developing sort of a multi-layer framework where we see the green transition minerals as the foundational drivers, but also some key ultimate drivers that are quite fundamental for us to be able to achieve the outcome of inclusive, sustainable sort of development. And the first part, which is the foundational driver, sort of fundamentally talks about how we can regionalize to do exploration on the continent, how we can regionalize to extract mineral resources, how we can regionalize to be able to do some geological services in ways that the ownership of these explorations, but ownership of these mines and exploration activities are on the continent, right? And we do know, for instance, that South Africa has a huge experience in mining minerals. We do know DRC has a huge amount of minerals, but also countries like Ghana and Nigeria who also do have some, for instance, crude oil, for instance, right? So there is a clear understanding of how to be able to sort of undertake some of these activities, and regional bodies, for instance, the African Mining Development Center, sort of consolidating some of these efforts could be useful in ways that we can regionalize some of these objectives. But as part of the ultimate drivers, we have identified, and these also sort of aligns quite nicely with Faisal's idea of a fair trade, but also transformative industrialization, where we are identifying AGTMs-led industrialization, where we are undertaking from a very regional point of view some beneficiation activities, but also the the production of some of these green, some of the green technologies. The idea here is that we do know some countries have some inherent capabilities to be able to serve as hubs for the initial sort of production activities, and the objective here would be then to sort of leverage some of those initial capabilities to be able to sort of regionalize some of this potential. But then also issues around integration, but also the development of regional value chain. So the idea is that based on trade and regional integration being based on production of minerals and adding value to our minerals, but also the production of these technologies, we can be able to undertake and add value in regional value chains in ways that work for the benefit of the continent. But what is also quite important from our point of view is around some of the issues that also Faisal touched on around infrastructure and others, right? We see these much more as key enablers of the structural pillars sort of coming together with the foundational driver to be able to generate the outcome we want. And he's already sort of spoken about sort of some of the infrastructure examples, but also we think we are thinking around some key regional policies around regional security, for instance, right? We do know some of the concerns are in the DRC has to do with the DRC's minerals, but also how the regional countries, but also some external interest are fomenting conflict. Yes.
Yeah. You need to wrap up.
Okay, are fomenting conflict in the region, largely based on some of the minerals, and then there are also issues around. We need to take into consideration some of the mineral governance issues and the finance issues that he's already sort of discussed. So to conclude, we do know that there are transformative opportunities in the green transition, but the fragmented nature of our approach and also the marginalized nature of our participation in the global value chains is not necessarily helping us. And we think that thinking around our approach from a very developmental regionalism framework as we are proposing would be quite useful in us thinking around how we can use our mineral resources to achieve a broad-based industrial development. Thank you.
Thank you, Elvis, for this interesting presentation and work around GTMs. Mr. Lloyd, if you are ready, I think you can share and then move on. Thank you.
Yeah, good morning. Can you hear me?
Yes, we can hear you fine.
Okay, excellent. Let me share the screen. Excellent. Thanks very much for the introduction as well. And thanks for the previous speakers. Very interesting listening to everybody speaking about industrialization and beneficiation as well. My presentation is called a producer-centered criticality matrix for South African manganese beneficiation from geological endowment to industrial power. Now, the point of beginning for us is that manganese is increasing in terms of demand. I want to start with the fact that everybody should be aware at the moment that we have a critical mineral, which is currently probably one of the most in demand in the world. And it's not gradual, it's not someday, it's happening right now. It's because the energy transition is happening, which is battery driven. Batteries need the manganese, specifically high purity manganese sulfate for electric vehicles. Analysts are projecting that the next few years, manganese will continue to grow, and to a large extent, it's growing because of metallurgy and the energy transition. Ferroalloys versus the nickel, manganese, cobalt, NMC chemistries, including the lithium phosphate, iron phosphate batteries. And of course, historically, it used to be ferroalloy, but now it is much more a critical mineral in terms of the battery electrification. And everybody at the moment is looking for feedstock for manganese. And South Africa at the moment leads with about 80% of the world's high-grade manganese. That's actually the the paradox of where we sit, that in the next few years, South Africa will continue leading in terms of production of manganese and exporting as well. Practically, we are the second largest producer, but we export around 96% of the manganese that we produce in South Africa. But if you look in terms of the growth trend for South Africa, we will continuously be the largest exporter of manganese. Not even Gabon is going to replace us, not even Australia, China, or any other country with manganese is going to replace us. But the problem that we have been able to establish in this instance is that we have not been able to capitalize on the growth of the demand for manganese, because we have always been looking at our policies and our strategies being influenced to a large extent by importer strategies. In other words, the export market. So if you look at the EU, the US Geological Services, including the IEA, they are not very much interested in the development of manganese or the processing of manganese for us. They are much more interested in their own supply. To them, they are asking, how much risk does this pose to our supply chain? That is actually what manganese is to them. It is nothing but a supply chain for them. They need to ensure they have mechanisms for risk mitigation, build up stockpiles. And their question is, are the impacts of trade disruptions on the US economy significant when they are in the economy? You know, in the result, if you look at the US Geological Survey, they score manganese 48 to 48 out of 100 in terms of criticality, moderate or near critical. To them, they look at South Africa and they say, well, it's a very stable environment. They are practically structurally blind to the producer country interests, in this instance, South Africa, as a supplier. Now, what producers need to be asking, as a producer country, we should be asking a set of questions. We need to ask a different set of questions. We should not be asking, is this mineral critical to them? We actually should be asking, can this mineral build our industry, jobs, and sovereignty? That shift in framing for us is the foundation of what we've been able to establish as the linkage-based criticality metrics that I'll be able to show you as we proceed with the discussion. What I've been able to establish as well is that we have a critical conversion gap that we have, not only in South Africa, but also in the rest of Africa as well. There is a lot of policy enthusiasm, if you look, and projects that have not been able to go forward. Everybody speaks about the barriers. We have heard about power shortages, fragmented institutions, misaligned finance and compliance hurdles. But if you look at that illustration that we have, for manganese, what we've been able to establish is that the critical conversion gap exists where we have high purity manganese sulfates, in other words, HPMSM and EMM. Conversion into battery grade precursor, we have not been able to build that capacity here in South Africa. We have manganese a lot. We have had smelters that have been doing ferroalloys, but also a lot of innovation and investment into processing manganese into battery grade HPMSM, including EMM. But we have not been able to build battery precursors. That is critically what, for us, the critical conversion gap, in the sense that what we've been doing has basically been to export the same HPMSM and the EMM to overseas markets. So not only are we exporting raw manganese, we're also exporting the same small projects, small produce that we have been able to process. Enter the linkage-based criticality metrics. We have the linkage-based criticality metrics, as you would understand, takes a lot of instruction from the linkage philosophies of the Cape Town studies, University of Cape Town, the Kaplinskis, the Kaplans. And we have improved that because we believe that they have given us the theory, but they have not given us the way in which we need to be able to implement it. So we have come up with 2 modules out of the linkage-based criticality metrics, which is the beneficiation linkage matrix. That is the strategic lens for us. It is the strategic lens in the sense that it is the sovereign importance. It classifies a mineral according to the importance to the sovereign. Whereas we also have the beneficiation feasibility matrix, which helps producer countries prioritize and sequence interventions. The linkage-based criticality matrix uses about 7 to 10 development dimensions, which are also publicly available. Sub-indicators, around 28 to 30 sub-indicators, which are also available. And we went through a Monte Carlo iterations, more than 10,000 for them, so that we should be able to understand the criticality of manganese in South Africa, looking at the basket of critical minerals that we have. So if you look at the visual illustration of the linkage based criticality matrix, on the other side, on the one hand, we measure mineral criticality. On the other, we measure the linkage strength. And looking at the quadrant that we have, and in terms of linkage strength, and using the linkage-based criticality matrix, we have found that manganese jumps in terms of importance from that 48 to 58% that the US Geological Survey allocates to 76.2% for us in South Africa. In other words, if we look at the beneficiation linkages and the feasibility, the beneficiation feasibility matrix, and we apply this to manganese, we see the importance of manganese jump for us as a producer country from 48 to 78. What do we do then? We need to be able to have a sequencing approach to it. We need to be able to pilot the way in which we speak about beneficiation linkages. At the moment, we have about 21 critical minerals. And if you look at 21 critical minerals and you say, which one can we beneficiate first? The beneficiation linkage matrix will be able to give you a clear indication of which minerals we can beneficiate first. If you look at the beneficiation feasibility matrix, it will be able to explain to you what kind of environment do we have that would be able to allow us to beneficiate these minerals. In other words, feasibility studies for it. So the idea is to have the linkage-based criticality matrix being piloted in selected corridors. These are going to be proof points. And then we look at creating a strategic intermediary, which to us would be able to be a secretariat that coordinates these. But critically, this happens because we have finance. So we need to be able to retool finance, look at blended concessional financing, look at the way in which we're able to bring in development finance institutions into the mix. For example, if you look at the Lobito corridor, it, for us, exemplifies both the BLM and the BFM. In other words, the beneficiation linkage matrix and the beneficiation feasibility matrix part of it. You look at the governments, which is basically the policy part, who have been able to take part and come together, different countries, also aligned to what everybody, the two previous speakers have been speaking about regional collaboration. And you look at the Angola, which is the port anchor of Lobito. You look at the DRC, which is the source of the copper and the cobalt. Zambia integrates its copper. The international partners, the DFIs that have come on board. And this is where now the finance part, the retooling part, finance part comes in. You see the European Union and the AFDB, including the development finance institutions, coming together in order to ensure that the Lobito corridor takes place. The coordination of it, which we spoke about in this slide as the strategic intermediary, you see the Lobito corridor investment promotion. And then the signaling from the sector. Mining companies are quite very, very sensitive to policies that change now and then. And if you look at Anglo-American and many others, there have been signals as well that indicated that they are quite very, very sensitive. They're quite accepting that the Lobito corridor represents a new opportunity in which we need to speak about value chains. So the linkage-based criticality matrix asks, what can a mineral do for a country? Not what the markets expect for the mineral. So if we go back to basics and start asking to ourselves, what can a mineral do for South Africa? What can manganese do for South Africa? Not what the markets can do for South Africa. So we brought about a matrix which is producer-centered. It diagnoses the policy environment. It sequences the policy using the BLM and the BFM. It's also a transparent methodology as well. And from our measurement using the linkage-based criticality metrics, manganese is a supercritical mineral in South Africa. Second to coal, of course. But the conversion gap that we have looked at in terms of manganese is also real. The last year we heard about the last manganese smelter closing here in South Africa. What now happens when we're exporting a critical mineral that could build an industry here in South Africa? So from where we see, the question now is not whether we can act, because we can. We have the smelters. We have about 78 smelters or 80 smelters. Only 12% of those smelters in South Africa are currently functioning. And the chrome effect, the manganese effect, all this mothballing that has been taking place is critically, is hurting the economy. This presentation, to a large extent, the criticality metrics, I worked with the professors that have been supervising me, Professor Rasmus Lima, Professor Rebecca Henlin, who are at the chair at the University of Johannesburg. I conclude by also asking you to look out for the new book, which is coming, which is called Anchorage. This is a book that I have written a short while ago. It's going to be published, I think in the next 1 or 2 months. It simply speaks about the same, what we are talking about, where global value chains meet traditional authority in the making of the modern South Africa. And we ask, can industrial policy be designed to respect what came before and build what comes next? It's a convergence of value chains, customer institutions, and state power, and it's coming soon. That's the end of the presentation. I think my details are on this slide if you would want to get in touch with us. So we should be able to speak more about the linkage criticality metrics. We have been able to share the criticality metrics with some of the largest EPCM companies, engineering, procurement, and construction management companies, that believe that we can actually build a value chain by asking the BLM and the BFM. In other words, asking whether we have the right policies and asking whether we have the right sequencing mechanisms together. So we are still exposing the linkage metrics to different stakeholders. We strongly believe that it will be a revolutionary exercise that can be replicable in the rest of SADC, in the rest of the world, if they would want to use and harmonize the way in which we understand criticality. Thank you.
Thank you so much, Mr. Lloyd, for such an insightful and interesting presentation. Indeed, it's well noted. I'm sure this resource will be available to colleagues after. Okay, Dr. Bogdanov, if you are ready, we can take you next. Thank you.
Hello, everyone. Can you hear me?
Yes, we can hear you.
Thank you very much. Good morning to everyone, and really it's been such a inspirational morning. I've learned so much. Thank you very much to the APORDE team, Dr. Saul Levine, for inviting me today. And I think, I've been listening to so many bits of different parts of the value chain that impacts on the green transition. And I hope today I'll be able to share with you some of the insights that we've produced in terms of data and governance, but also taking into account the African continent and specifically Nigeria. So for decades, we've seen industrial development policies, and even today, as we've been speaking, built around familiar pillars: productivity, infrastructure, trade access, and manufacturing capacity. But something fundamentally in terms of the world has changed in terms of the global economy. Countries are no longer just competing on labor cost and productivity. They're competing on carbon competitiveness. Now, earlier on, the speaker, there was, pardon me, I didn't take down his name, so my apology. But spoke about manganese and, looking at mothballing and removing that mothballing and creating productivity in South Africa, for example. But I think what is extremely important is that when we look at this productivity, we need to look at how this carbon competitiveness is going to affect us because of climate policies. So climate policies are no longer about an environmental regulation. It is about operating through the capital markets, the trade systems, and financial risk pricing. And that is something that we are seeing, and it is really important that we take it into account for Africa. Of course, emerging markets, industrial development is no longer about just building factories. So it's increasingly becoming about what Dr. Faisal, Professor Faisal spoke about as well in terms of governance and looking at building credible data systems that's going to look at governance frameworks in Africa and look at this climate disclosure infrastructure. So to explore this shift, I want to talk about the case study of Nigeria, which is Africa's largest economy, and as a real-world stress test on how ESG risk is emerging in terms of capital pricing and in the emerging markets. And why Nigeria? It is one of the countries in Africa that has promulgated the S1 and S2 IFRS regulations. And because it has done this, it has taken the stance together with a few other countries to take up the regulation of S1 and S2. Their capital markets have to be ready for this. And that's why I want to talk a little bit about it, because without money, without capital, all the industrialization that we want to do in Africa really goes onto the wayside. So that structural shift in terms of carbon competitiveness is already happening in the global economy, irrespective of the rollbacks of climate change policies in the US, also the wars that are currently taking place. Irrespective of all of that, every economy that you speak to and every regulator that is working on different policies are looking at this shift in terms of greening. So historically, countries competed on the basis of labor cost, as we've seen in China, productivity in terms of what we've seen in the US, access to markets because of capital and the shallow markets in Africa, and energy prices, because without energy, nothing can be done, right? So another variable that has entered into this equation is carbon intensity. So in other words, global production systems are increasingly being evaluated about how carbon efficient they are. So that carbon efficiency has become a really important part of driving competitiveness and change in the world. So this shift is driven by a combination of climate regulation, investor pressure, as well as the capital markets. Now, if we look at the carbon regulation, we all know that CBAM came into effect on the 2nd of January in South Africa, for example. And so if you want to export manganese, and if we don't want to be, we want to ensure that we are not buying our lithium batteries and we're actually using our lithium to produce the batteries, we've got to ensure that this carbon intensity and the carbon process of manufacturing is taken into account because of protectionism. Because another protectionist regulation that has come about is the CBAM regulation through the IFRS S1 and S2 regulation. And this is really, really critical in terms of how we take into account competitiveness for the region, but also for Nigeria and for the continent. If we look at Nigeria per se, the industrial policy frameworks across Africa has traditionally focused on physical economic structures. So these include manufacturing capacity, infrastructure development, and export competitiveness. However, the global financial markets are introducing an additional dimension. So investors are looking at the climate exposure, so our physical risk and our transition risk across Africa, and how the value chain of the financial system is actually measuring this. And that's taking into account the governance quality, and that really is addressing the aspects of greenwashing. And if we don't have credible data, we would have to use proxy data, which would mean that we would be using information or carbon data of the global West. And if we do that, Africa would actually be paying a massive price because we have the lowest carbon footprint on Earth. And if we have the lowest carbon footprint on Earth, by default, the data that we are producing amongst all listed institutions that will drive capital into the African continent will be lower than everyone else because of high carbon sinks, high carbon credits, and also because we've had low consumption patterns because we have been producing and it has been manufactured somewhere else and consumed somewhere else because we've been poor. And because of that, our data transparency for the first time in the history of the world means that we would be able to provide information and that competitiveness through our data. So the information credibility through data is going to be very, very key for Africa and for all countries on the continent, including Nigeria. If we look at Nigeria per se, Nigeria provides an ideal case for this study because we're looking at ESG risk and how it interacts with industrial development. So the country is one of the largest economic systems in Africa, both in population size, but also with economic scale. Yet its capital markets remain relatively small compared to the size of the economy. So Nigeria boasts the impact of its industrial nature as well as its people. But the capital markets of Nigeria is so shallow. And on top of all of that, it's volatile. And then you have the whole aspect of governance that is weak. So if we want to, as a continent, and Nigeria wants to prosper, that data integrity and the information that we have is going to be very, very critical in terms of how we produce that for market capitalization. And if you look at the market cap of Nigeria, which is the Nigeria Securities Exchange, it roughly fluctuates between 20 to 35% of its GDP, reflecting this structural macroeconomic volatility. And it's extremely important for us to take this into account, both from a private sector perspective, a public sector perspective, and as well as academia, in terms of how does this these aspects actually integrate into the success of Nigeria going forward. So Nigeria makes an important stress test for the capital markets in emerging economies. It also represents a very big structural paradox because on one hand, it has this huge economic potential. And on the other hand, it has one of the largest populations on the continent and significant natural resource wealth, but it has a high dependence on hydrocarbons, oil and gas, as well as youth unemployment is a huge problem because of the structural challenges, as well as the government fragility. And these tensions shape how the global investors interpret risk. So irrespective of all the great things that we have on the continent, global investors have not come in and dumped their money into Africa because we've, pardon me?
Yes, you have 2 minutes remaining if you could wrap up first.
Thank you. So if we look at, so I'm going to just try and skip a few slides very quickly. I'm going to talk about how the data is extremely important. So Risk Insights, through the company that I founded, developed the first artificial intelligence machine learning model for ESG for the African continent. So it has the largest database of carbon information, as well as natural capital, social data, as well as governance data that basically has been collected independently from publicly and voluntary and mandatory information for every listed company on 9 capital markets using an AI algorithm called TF-IDF. And we've created a rating tool that basically provides this information so you can see through into the capital markets. And this information is being used across the globe by large asset managers, quite a number of Ivy League institutions together with issuers to drive the carbon intensity as well as the calculations in Africa. So if you look at Nigeria itself, right, so they have adopted this regulation of S1 and S2. But if you look at the company disclosures, it's showing you that the capital markets itself is not ready for this change. And when you're not ready for this change, money is not going to flow in. And that's just a reality. So it's very important from a governance perspective. So if you look at the net zero targets, the emission reduction targets, less than 10% of their market, the capital market, is actually ready for this, which would mean that the discount rates as well as the cost of capital will rise. And that's a fact, because that's, we've already seen that. And in terms of social indicators, I think earlier on, Professor Faisal spoke about how difficult social indicators are, and in terms of inclusivity because of different cultural differences and so forth. And within 55 countries on the continent, this needs to be taken into account in terms of not a one-size-fits-all, but also taking into account what are you disclosing in terms of double materiality, in terms of what you're doing great for the companies within the country, as well as what you're doing for the communities that will basically support the ESG and sustainability SDG goals of the United Nations. So I'm going to leave it there, and I'm not going to go through every slide because I've run through my time, and I wouldn't want to take up anyone else's time. So thank you very much for that. I hope this was insightful to you.
Yes, thank you. It was very insightful for your presentation, Doc. We'll now move to Q&A session. If anyone has questions for our speakers, or even from the opening, you may just raise your hand, and then we will give you the opportunity to present your question. We have 15 minutes for this. We have 15 minutes for the Q&A. So you are welcome to present your questions if you have them now in a chance, or notice to any of our. Yes, so first question from LeBron to Dr. Bogdanov. They're asking, how do you view the current backlash taking place against the ESG? Doc, if you do want to respond, you may do so.
Sure, thank you very much for that. I think the backlash is because of the greenwashing. So if you look at the major asset management companies, and I'll take an example, which is public information regarding BlackRock, right? So BlackRock, Larry Fink and his team were basically punting ESG a few years ago. And if you look at the level of greenwashing that took place in the BlackRock portfolio, basically created a whole lot of funds to basically roll back on, the disclosure. If you look at major institutions across the globe in terms of how much of greenwashing as well as how many criminal penalties have been laid on companies, this has basically created many institutions and asset managers to relook at the data as well as looking at their risk appetites and tolerance levels. Now in Africa, there hasn't been backlash, but there has been more a policy issue. What we found is that many countries, because we have all these critical minerals, as well as we have, for example, Nigeria, Sudan, and a few other African countries that have huge reserves of oil and gas, believing that, because of ESG and because of measuring of carbon, we would not be able to, or even South Africa, because of fossil fuels, we would not be able to be profitable. And that is actually not true, because you've got to then look at your carbon offsets, you've got to look at your carbon sequestration, you need to look at the green technology that will basically bring in the ability of Africa to be to look at new revenue streams, new kids on the block, as well as moving away from monopolies to actually widening and deepening the capital markets, as well as SMEs and new players on the African continent. So I don't see the backlash. I think there is more the greenwashing that has taken place across the globe by major institutions that has caused that problem. Because climate change is here.
Yeah, we have 2 more questions. And in the interest of time, I think we can balance out your response. So let me read the 2, and then our speakers can decide how to handle them. So the first one is, does the ongoing geopolitics have any effect on ESG outcomes? This is from Adesuchi. And then from Ernest, how do you strike a balance between Lloyd's presentation and that of Dr. Bogdanov? Because as much as we need to look at the emissions, we also need to industrialize to create the jobs needed by the continent. This is a similar question I had. I think it's for all the speakers. I know we are talking about some of these emerging concerns relating to industrial development, but overall, how do we balance what we need to do as far as expanding industries versus protecting the environment? The last question for Elvis is, what do you think has stalled progress on the Zambia DRC critical mineral agreement? Since Dr. Bogdanov spoke first, perhaps Elvis, if you want to respond to this, and then after Lloyd can come in before we come back to Anushka.
No, thanks for that, Piri. I think it's simply sabotage, right? My sense, and from reading some of the documents as well, is US joined the trilateral negotiation about the relationship because they did not want China to join. And since they joined, nothing has happened on the Zambia DRC critical mineral battery relationship. So the hope now would be for the countries themselves to take the initiative on, but also try to work a bit more closely with other countries that are developing EV battery value chains, and also possibly auto value chains like Morocco and South Africa. That may probably be a good way to go. But given that the US is already in there, it may be tricky geopolitically, but they may have to see.
Right. Thank you so much, Elvis. Lloyd? Okay. We can take him after Anushka if you're ready to respond. There is actually one more question for you. Someone's asking if employees and board members should be penalized for professional negligence on greenwashing instead of the firm. So I guess you can just package your responses in the next minute or 2.
Thank you very much, Dr. Rex. I think the most important piece is that when in terms of ESG and greening and technology, we see, and I've just finished a paper with looking at market cap behavior towards ESG disclosure for an entire stock exchange, which is the JSE, as a case study. And so the job opportunities and the greening opportunities through this new green industrialization is vast. But in order for that to take place in Africa and South Africa, on the continent per se, it means that our data as well as our governance has to be strong. So, I mean, in terms of water technologies, energy technologies, new ways of reskilling people, as well as new companies forming, creates new job opportunities and employment. And we see this as a major opportunity for the continent. And we can look at that in more detail if you want to do that on offline with me. The other aspect in terms of boards and institutions in terms of greenwashing, I think a lot of boards are starting to get educated in terms of ESG. There's been a lot of pushback by older board members because it's a pivot, and because that value chain from moving from shareholder value creation to stakeholder value creation. So moving away from Milton Friedman's, theory of Wall Street built on, just on the returns of companies is actually, it's diminishing. Which means that a lot of stakeholder value creation is extremely important, and board members are starting to look at that pivot now. Many are accepting it. Because most institutions have been built on looking at the ROE, and even board members were looking at shareholder value. So that change is taking place. And where there is greenwashing in terms of signaling, in terms of the integrated reports and sustainability reports, that is where data becomes critical, because you are able to then measure the information that is being published versus what is actually happening with the company, and in terms of news feeds and sentiment, as well as the employees, as well as the communities that are part of the branding and the credibility of institutions, which impacts on board members. And when there is greenwashing, everyone should be looking at, or all regulators should be looking at those board members that are part of the issuer.
Thank you so much, Doc, for your responses, and I believe it's been a insightful conversation. It does touch on, some of these critical issues that one may need to reflect on working in this area of industrial development, and it's applied or related issues as far as Africa is concerned. Indeed, it does signal that there is still a lot more work that needs to be done, a lot more consciousness and research and evidence that needs to contribute to the debate. And we're sure that as time goes on, we know that everyone here, members of the APORDE alumni, will keep contributing to doing this type of work. I want to thank the speakers for a fantastic session, and for presenting such insightful work, and we wish you well in your future endeavors. Thank you so much, and on to the next session. Cheers.